On behalf of United Church Funds, I want to welcome you to this UCF Town Hall webinar. I'm Charles Buck, President and CEO of UCF, and the UCF team joins me in bringing you greetings and expressing our hope that you and your families and all your communities are well in body and spirit. In these quarterly town halls, we share updates on what UCF is doing on your behalf as responsible investors. And we also talk about what happened in the market this last quarter, your investment portfolio's performance, what to expect looking ahead. And finally, we'll take your questions, which we encourage you, by the way, to put into the Q&A anytime during this webinar. We'd like to start by quickly finding out who's in the room today. There's going to be a poll question that pops up on your screen, and just choose the one that most closely fits you. And as you're doing that, I'll just mention that we started these town halls over a year ago when COVID placed restrictions all around us. We wanted these town halls to be a way for us to stay in touch with you and all of our clients during COVID. And we intend for them to provide information and resources for your boards, investment committees, church members, or your constituents. So we highly encourage you to share everything you hear. Pass along the video and slide decks, which will be available probably tomorrow, and come back to us anytime with your questions by email or phone. And mainly, we hope that these town halls can help you and your church organization learn how your assets are both supporting your mission and making a real difference in the world. Well, let's see what we've got. And I see that most of us here are investment or endowment committee members or trustees of our churches or organizations. And then the other categories about equal. So we welcome everyone, but we're really glad to have the Investment Endowment Committee members here. These webinars are particularly geared toward you. So on the next slide, you're going to see our UCF team. Today, you'll hear from Stacy Pettis, our Executive for Institutional Relationships. Matthew Ilian is the Director of our Responsible Investing. Matt Wagner is the Vice President for Institutional Relationships, and he'll be in dialogue with our investment team from the pension boards, Dave Klassen, Lon Kai, and Minotti Dhanaraj. And helping us with the tech side of things are Debbie Weibo and Adam Sank of our marketing and communications team. So if I could get the next slide, and let's go one more. And on this slide are listed UCF's Board of Directors and Investment Committee. I want to introduce to you 5 new persons who are starting terms on our board. They're Cameron Barr, who's a senior pastor of United Church of Chapel Hill in North Carolina. He's also the new chair of the United Church of Christ board. Lynn Bunyak is a conference minister of the Vermont Conference. Donnie Mooberry-Slow is an attorney and financial advisor in Lawrence, Kansas, a member of Plymouth Church in Lawrence, Kansas. Noah Tabor is an attorney, a member of Ankeny United Church of Christ in Ankeny, Iowa. And Bernard Wilson is the senior minister of Northfield Congregational Church in Weston, Connecticut. All of these new board members bring considerable skills and experience and diversity to our already talented and diverse board. I invite you to learn more about them, as well as all of our board and investment committee at our website, ucfunds.org. Finally, before turning to Stacy, I want to express our sincere thanks for allowing us the honor of being your partners in faithful stewardship. With COVID on the rise again, we face an uncertain future, but the church's work and God's mission continue, and perhaps they're needed now more than ever. UCF is committed to walking with you and helping support you in your ministry through the responsible investing that we do. So let's start the program, and I'm honored to turn things over to Stacy Pettis. Stacy?
Thanks so much, Charles, and welcome everyone. As many of you know, for over 100 years, United Church Funds has invested wisely to help churches and faith-based organizations achieve their financial goals of their ministries, while aligning portfolios to progressive Christian values regarding environmental, social, and governance factors. We provide resources and services to strengthen our clients' portfolios and endowments governance structures as well. If I could get the next slide. The UCF staff and board of directors has been busy since the last time we reported updates to you. So I am excited to share with you some of the work that we've been doing. In July, United Church Funds participated in the UCC's General Synod 33. We were a gold level sponsor in collaboration with the 4 other financial ministries of the UCC. We hosted a workshop on sustainable investing and implementation for organizations. And we also partnered with MESA, which is the Ministerial Excellence Support and Authorization Team, to host the educational and engagement event for members in discernment, where they had an opportunity to mingle, learn about the financial ministries, and hear from UCC officers, Reverend Dr. John Dorhauer, Reverend Tracy Blackman, and Reverend Dr. Karen Georgia Thompson. We also invite you to take a look at the updated joint website of the financial ministries, where you can obtain some clarity on the differences between the organizations and seek resources for other financial needs that your church or organization may have, such as lending, capital campaign support, insurance, and pensions. We also, on August 5th, the UCF, in partnership with the pension boards, co-hosted a climate symposium. It was a live event with open remarks from Jim Antal and moderated by our Chief Investment Strategist, David Klassen. Attendees were able to get a historical look back, as well as a forward-looking vision for how investments support climate justice. Such robust information was shared with the UCF and Pension Board's Investment Committee members, and we look forward to sharing clips of the recorded sessions with you all soon. For decades, United Church Funds has worked diligently to provide faith-based investors with an investment platform that can meet their needs, no matter where you may fall on the risk and return spectrum. And over time, this has resulted in our platform having 13 different fund options. Our most used balance fund is the Moderate Balance Fund, which currently has 370 million assets. In comparison to our Conservative Balance Fund, which has about 12.8 million, and the Aggressive Balance Fund that has about 56.5 million. So as you can see, these 2 balance fund options have been underutilized. So we've done some evaluation of our fund lineup and decided to consolidate 3 of our balance fund options into 1 diversified flagship UCF Balance Fund. This fund will have an allocation target of 60% equity, 40% fixed income, which is the exact same target of the Moderate Balance Fund. So for many of you all, many of our clients that are invested in the Moderate Balance Fund, there will be no change other than the name of the fund. We will be reaching out to clients that are currently invested in the Conservative and the Aggressive Balance Funds to educate you on your options to either customize a portfolio to achieve the same allocation that you had previously. And you can do that using our Total Equity Fund and our Fixed Income Fund, or we can speak with you about transitioning to the rebranded UCF Balance Fund. And for those of you that prefer to take a deeper climate lens within your portfolio, the Beyond Fossil Fuels Balance Fund is still available to you and has a 60% equity, 40% fixed income target allocation as well. In the same spoke of some of the rebranding and renaming that we're doing, we will be renaming our Alternative Balance Fund to a name that more accurately reflects the allocation strategy within that fund option. So not a lot of our clients use this fund, but some of our largest clients do, and they use it to diversify to more illiquid assets such as private equity, real estate, and hedge funds of funds. So we'll be sure to update you of that official name change once it's finalized. And now I have the pleasure of introducing our Director of Responsible Investing, Matthew Illian, who's going to share some really amazing things that are going on in that space. Matthew?
Thank you, Stacy. And before I jump into my presentation, we have another poll question. And so if we'll put up that question, we're really looking to gauge your comprehension of all the acronyms that are used in the SRI, or Sustainable and Responsible Investing space. So you can check multiple options here. I'd like you to. All of the acronyms that you have a comprehension of, what these acronyms stand for. If you could check them. This is not a quiz. It will not be graded. This is really just a chance for us to make sure that we're being clear in the communications that we're using and make sure that we're all on the same page. So go ahead and place a check, and while that's coming in, when we have enough responses, we'll publish those results. But like many fields, the fields of sustainable and responsible investing, socially responsible investing, is an alphabet soup, and so it's good to just kind of review what those mean. Okay, so we see here, most of you feel very comfortable with ESG, and Stacy went over that. That stands for environmental, social, governance factors. And essentially, those are factors beyond the traditional financial accounting factors that are now investors are saying they impact the bottom line just as much as the accounting factors. Oh, if we can go back to publishing those. Okay, I just want to talk through each one. ICCR, that's the Interfaith Center for Corporate Responsibility, of which we and the pension boards are founding members. And I'll talk more about ICCR. SDG, that stands for Sustainable Development Goals. And that's a UN recognized and sponsored term for ensuring that positive impact is happening across all sectors. So it looks at things like health equity, access to quality education, access to clean water. Those are the Sustainable Development Goals, SDGs. DEI, that stands for Diversity, Equity, and Inclusion. So we will we'll talk more about that as well. And then lastly, PRI. PRI is another group like ICCR. It's the Principles of Responsible Investing. Also, this was an initiative started by the UN to promote responsible investing activities. So thank you for indulging us and sharing that information. So what I want to present to you on this next slide is really an overview of the shareholder or proxy meeting season. And we're currently at the end of the season. And the four things that we want to go over. Number one, the headliner of the season was what happened at Exxon this year. So we'll start there. Then we want to cover the ESG votes, or the shareholder votes related to ESG factors. The third category I want to cover is around a deep dive on climate lobbying and how the attention there is really changing the game. And then we're going to I'll close this section by giving some reflections on shareholder votes on executive pay. So if we'll go to the next slide. So at ExxonMobil, the big story was that the shareholders nominated 4 board members in opposition to 4 members that were nominated by management. And both sides, it was a big proxy battle. Both sides put a lot of investment into this. And it turned out that, that the shareholders won 3 of those 4 seats. This was the first time anything like this had ever happened at Exxon. The 3 directors that got nominated are all low carbon energy transition experts. And so it was all about sending a message about priorities at the company. Now, the backstory to this is that this was led by a hedge fund called Engine No. 1. They owned 0.02% of Exxon's $250 billion of market capitalization. So a very, very small amount. Typically, activists have to come in with a larger, kind of a larger holding. But what they did was they were able to convince some of the largest shareholders that this was a priority. And in fact, it was led by hedge fund activist veterans. So the two veterans, Chris James and Charlie Plummer, had both worked for other activist hedge funds in the past. So what was different about this activist strategy is that the way that they were saying they wanted to enhance shareholder value is by focusing on sustainability and focusing on a carbon transition. So it was the first time we saw a board takeover effort that was really focused on sustainability. And that's what really changed the game. And also the fact that the largest investors, the largest funds, including BlackRock, Vanguard, the New York and California pension plans, all ended up supporting these 3 board members. Now, climate change and climate wasn't the only shareholder agenda on the ballots this year that drew attention. This next slide really shows a broad overview of all of the majority wins by our partners through ICCR. So these are all faith and values-based partners that put up shareholder resolutions. And the resolutions are covering lots of different categories. In fact, this year in 2021, the #1 category for shareholder resolutions was around diversity, equity, and inclusion. And you can see there was basically a 100% increase in the level of majority wins among these ICCR shareholder resolutions, which was something that our colleagues really celebrate, and we celebrate with them, that shareholders are now putting more of their voting power behind some of these environmental, social, and governance factors than ever before. If we'll go to the next chart, or sorry, next slide. We want to do a deep dive and share with you around climate lobbying, because this is a factor, an effort, an initiative that we've invested a lot of time and energy in. And we want to first lift up the champions of this. So the ICCR is, I've mentioned already. Climate Action 100, they're benchmarking the 100 largest carbon emitters in the corporate carbon emitters around the world on their commitment to fighting climate change. And then Ceres is another important actor that brings these investors together to support these important efforts. Now, lobbying is important because for a long time, companies have been able to say that they are defending the environment, they're supporting Paris, while at the same time, their lobbying dollars are going to associations that are continuing to support business as usual. My best analogy I have for this is as a parent. During COVID and during the pandemic, all the parents out there with young kids will maybe sort of relate to me when I say that the amount of screen time my kids have consumed have gone way up. And so, trying to be a responsible parent, we will communicate daily to our kids that it's time to end the screen time to turn it off. And sometimes our kids will, pretend they didn't hear us. That's one strategy. And we've seen that in the corporates as well. And at other times they'll say, okay. And then you hear, can I just finish my game, or can I just finish the movie or my show? And again, that's another strategy that corporates use. Can we just, we'll do it in time. And essentially what we're saying as investors in this time, that enough is enough. It's time to turn it off. It's time to turn the screens off. It's time to turn off business as usual. And so if we go to the next slide, we'll share with you the support that we've seen around these climate lobbying resolutions. And essentially they're looking at how companies' lobbying dollars and the membership organizations that they're part of are being analyzed for their own climate convictions. And so you'll see of the 6 shareholder resolutions, all passed with a strong majority at Sempra, Delta, Exxon, Phillips 66, United Airlines. And then the biggest win came with Norfolk Southern. And that's the one that we were involved with. Our friends at our colleagues at Friends Fiduciary, which is a Quaker investment organization, much like United Church Funds, led this effort and we supported them. And in the first conversation that we had with Norfolk Southern, their response back to us was that trains are a more efficient vehicle than trucks. And so we are by nature an efficient company. That's what you should care about. And our lobbying organizations are kind of a side story. Well, again, going back to the analogy, we're kind of saying at this point, no, all of your actions need to be in alignment and support of the Paris Accord if you are declaring yourselves that you're supporting Paris. And so we looked at and researched the 3 lobbying organizations that they were members of, and you see them listed here, and all 3 had concerning commitments and connections to promoting business as usual when it comes to coal, when it comes to traditional oil and gas efforts. And so this vote essentially asked Norfolk Southern, and by passing with such strong majority, demanded that Norfolk Southern create a report that analyzed all of these membership committees and responded with what they were going to do to ensure that these membership organizations supported the values that they supported, or if they didn't, what were the steps that they were taking to ensure that their values were intact. So that was very exciting and something we wanted to share with you. This last slide that I want to share is focused on executive pay. And there's really 2 stories here. So the first story that I want to share with you is that, well, first, the preface here is that every year at every company, investors get to vote, which is called a say on pay, on executive compensation. Now, this is a non-binding advisory vote, so it's more about sending a message than demanding action. But in this case, in 2021, we saw that a 50% jump in investors who rejected the pay package or executive compensation at corporations. So it went from 2.2% to 3.6. 50% jump, that's a huge jump, and we are definitely celebrating that investors are starting to pay attention. The other story here is that only 3.6% of investors or companies had lost their say on pay. And we're living at a time of increasing income inequality. The Gini coefficient is higher than ever. And we'd like to see more investors paying attention to this. Personally, at UCF, we voted against 11.6% of all of the pay packages. And a lot of our values-based colleagues did as well. And so we think there's more room to be to kind of move in this space to send corporations the message that out of control pay packages to executives are not tolerable, especially during a COVID season, especially when so many are suffering, and yet those on top are doing so well. The example of a pay package that lost a say on pay that was kind of a headliner was at Starbucks, and you can see here the CEO, Kevin Johnson, ranked number 43 of the most overpaid CEOs. In this case, 52.9% of shareholders voted against the pay package. Johnson's total compensation this past year was $42 million, and that was a base salary of $1.5 million, and the rest was all incentives. And what really irked shareholders is that there was an incentive placed on top of an incentive that was going to be paid out even if Starbucks lost money for shareholders. And so, this was a case where the shareholders just said enough is enough. The CEO to employee median pay at Starbucks is 1,211 to 1. So again, this is an issue that we care about deeply, and that rounds up our proxy season shareholder review. And so with that, I'm going to pass the microphone over to my colleague, Matt Wagner, VP of Institutional Relationships.
Matthew, thanks for that information. I appreciate it. And it looks like we're going to do another poll question before we get started with some performance updates and some forward-looking views on strategy. We have this will be our last poll question. It's on COVID resurgence. With the resurgence of COVID and concerns about the Delta variant, what changes do you foresee in your church's activities in the coming month? And you can check all that apply. We've got several options there. So I encourage you all to go on there and participate in that poll. And of course, the reason that we have a COVID question in here is that this helps us in our communication strategies with all of you. So if we know that most of our clients are going to be remote or doing things online or still doing Zoom and are putting off some personal visits potentially from our staff, that helps allow us communicate as effectively as we can with all of our clients. And it looks like of the answers that are up now, it looks like returning to online church service. Looks like a few are delaying capital campaigns or improvements, potentially using an emergency fund or perhaps some special spending out of an endowment, reducing program expenses. We certainly wish you all well over the coming months, and certainly wish your churches well, and hopefully we can get through this trying time again all together. So thank you for participating in the poll. And with that, we're gonna switch gears and talk a little bit about investment performance and some themes. As we look at the themes that drove market returns in our allocation strategy in Q2, it's important to notice that there was a subtle shift by investors back to growth-oriented companies from the positive returns we saw in the first quarter of 2021 from value stocks. As your trusted investment partner, it's important for UCF to keep our eye on the target as it relates to a longer time horizon than just 1 or 2 quarters, but we can't sacrifice the ability to remain nimble to shifts in or out of favor sectors or investment styles in order to provide our clients the optimal level of risk-adjusted returns. One way that we accomplish this on behalf of our clients is to utilize multiple investment managers in a single fund who focus on growth, value, or core strategies. Our experienced investment team can then elect to slightly overweight or underweight a manager based on their growth value bias, what we refer to at UCF as tilting the portfolio or being dynamic as it relates to asset allocation. If we think back to the second half of 2020, portfolios with overweights to growth strategies, think large and mega cap tech companies, the Microsofts, the Apples, the Googles of the world, outperform portfolios that lean more towards value strategies. Think about those cyclical and defensive sectors like banks, utilities, industrials. As investors turn the calendar from 2020 to 2021, and as we entered the first quarter of this year, high valuations in growth sectors, rising US interest rates, and other factors led investors to turn their attention and their dollars to those sectors whose performance had lagged in 2020, those value the cyclicals and defensives. They had more attractive relative valuation there, and the S&P 500 was up 6% in Q1. Very nice start to the year, and performance was led by those sectors. As we examine drivers of investment returns in Q2, we again noticed that sort of subtle shift in investor sentiment I mentioned earlier. Returns in Q2 were driven by a reversal back to growth stocks as valuation began to look more attractive against return expectations, given the better economic data and vaccination efforts. We continue to be vigilant about these changes in sentiment and be flexible in our approach to asset allocation. If we switch to the next slide. Thank you. On the left of this page, we have various equity and fixed income index returns for the quarter, year to date, and annualized. I'm going to stop for 1 second. I want to make sure that we're getting a couple of questions as it relates to the screen, and I just want to make sure that we have that taken care of before we go any further. We have it squared away? Okay, looks like we do. So apologize for those of you who maybe were having an issue with the view. I think we've got that taken care of. So as I mentioned before, on the left there, we have various equity and fixed income index returns for the quarter, year to date, 3, 5, and 10-year time horizons, as you can note there. If we look at the index returns, which are about the top half of that list, We can look to several of those, and the S&P 500 returned 8.5% in Q2, led in large part, as I mentioned earlier, by the largest names in the technology sector. Also generating positive returns in Q2 and year-to-date 2021, although trailing US stock market returns were equities in developed overseas markets, which is referenced as the MSCI EAFE, or Europe and the Far East Index, and international emerging markets, which is referenced through the MSCI Emerging Market Equity Index. Both of those asset classes provided high single-digit returns year-to-date in 2021. When we blend together US and international equity returns, we reference an index at United Church Funds from MSCI called the All Country World Index, or ACWI, which includes some 9,000 large, mid, and small cap stocks across 50 countries worldwide. For those UCF clients who use a balanced fund, the equity portion of your portfolio is benchmarked to the MSCI ACWI. This index has returned nearly 13% year-to-date through the end of June. As we shift to the charts on the right side of this page, you'll notice that we've seen an exceptionally volatile US interest rate environment over the past 18 months. Institutional investors like United Church Funds regularly refer to the 10-year Treasury rate as the favored barometer of rates in the US. So let's take a closer look at that particular rate. As we started 2020, about 18 months ago, the 10-year Treasury was around 2%, but as the impacts of the pandemic started to become more clear, the US Federal Reserve swiftly took action to lower rates in order to provide a very accommodative environment for the US economy. And in just a few short months, the 10 years was slashed from 2% to 0.5%. But since the summer of 2020, about a year ago, rates have tripled. And through June 30, 2021, the 10 years stood just shy of 1.5%. This whipsaw effect has made returns in fixed income asset classes difficult to come by. And in fact, year to date in 2021, through the first 6 months of the year, the only bond asset class with a positive return has been high yield bonds, which actually traditionally have a higher correlation to equity markets than most other bond asset classes. As the US economy continues to improve over time and recover from the impacts of the pandemic, rates should trend up, albeit slowly, which actually leads to lower return expectations for fixed income investments, which we perhaps will talk about a little later. If we switch gears to slide 19, we're going to take a look at two slides that have United Church Funds performance versus an index and also versus its peer group. On slide 19, you'll find our managed fund returns over various time periods. If we focus on the year-to-date 2021 net of fee returns, you'll see that UCF's fixed income, domestic core equity, beyond fossil fuels, and alternatives funds all have outpaced their benchmark index through the halfway point of the year. The International Equity Fund only missed matching its index by 1/100% or 1 basis point. Trailing over a shorter period is the Small Cap Equity Fund, and although this fund's performance over the 3-year and 5-year average annualized time periods still stands up against its index, the Russell 2000. If we switch to slide 20, this slide focuses on UCF's balanced fund returns, which include the assets of many of our clients. And in addition to using an unmanaged no-fee index, which I referenced for the managed funds, we also use what we call our Lipper Peer Group Index. It's an index created by averaging the performance of other active managers who are responsible for managing mutual funds in similar categories to ours. Particularly in examining the performance for balanced funds, it's important to include the Lipper peer performance data over longer time periods because it includes relevant factors such as the impact of fees, the use of active management, the tilting of the portfolio I mentioned before, the use of short-term decisions to overweight and underweight asset classes, and to use cash to deploy in the portfolio. Of the 5 balanced funds that have Lipper peer data, as you see on the screen, if we look just at the 3- and 5-year average annualized time periods, so for those 5 funds over those 2 time periods, that creates 10 different time periods. Those 5 funds outpaced their Lipper peer performance in 9 of those 10 time periods. The lone exception being the 3-year performance of the aggressive balanced fund just slightly trails its Lipper peer group. This consistent outperformance has 2 drivers at United Church Funds. First, our investment team has done a superb job managing these funds, tilting the portfolio, using the overweights and underweights as they deem fit. And second, UCF has done a pretty darn good job with prudent stewardship of our internal resources. We've been able to lower the impacts of fees on returns over the last several years. Both factors are benefits to you as our clients. We switch to slide 21. And we're going to also transition from looking at past performance to looking at a few economic factors that form the basis of our forward-looking investment strategies. I want to introduce Dave Clausen, UCF's Chief Investment Strategist. For those of you who have participated on these calls in the past, Dave's no stranger, and his team, Lana Minotti. We welcome you, Dave, Lana Minotti, and we thank you for sharing your team's vision for the next few months related to asset allocation.
Thanks, Matt. It's great to be here.
Yeah, thanks, Dave. We've got two slides here that we're going to show back to back that relate to a common question we get from our clients in portfolio review meetings that focus on a sort of perceived significant chasm, if you will, between Wall Street and Main Street, with many clients believing that the equity market returns, supported in large part by government spending and the Fed, have outpaced the realities in local economies, particularly around discounting the impacts of COVID, to the point that we risk a strong potential snapback in equity markets. Yet, as we see from this chart on slide 21, economic data in sectors like consumer spending, dining out, travel, home buying, mostly have returned to within at least earshot of pre-pandemic levels. If we turn to slide 22, if we could flip that slide, Adam, thank you. We see that at the same time the economic data looks healthier, the Federal Reserve continues to support markets with highly accommodating rates. The federal government is spending at historic levels. If you look there on the right, the CBO is predicting that net debts of the federal government will be more than 100% of GDP expectations over the next decade for the first time since World War II. Just today, we saw the Senate pass a bipartisan infrastructure bill, putting more workers into an already improving economy. So Dave, without asking you to predict the next turn in the global pandemic, which could have put a wrench in anyone's plans, can you address how UCF might be positioning our balance funds over the next coming months to take advantage of the continued federal support of the economy? And should investors be overly concerned with a near-term snapback in equity markets?
Thanks, Matt, and welcome everybody to the call. I think the answer is fairly straightforward, and that is because we have a reasonable, flexible approach, we're able to do a lot of the worrying for you. As my colleague Lon Kai would say, it's easier to figure out the attractive buying point and tougher to sell. So as you know, in 2020, during the March period of time, we aggressively bought equities. We've refrained from doing too much selling here, although we do rebalance the accounts and the equity exposures down a bit. But the combination of earnings growth, improvements in the economy and central bank support has led us to continue the overweight, but monitoring that very closely. And if the economy shows signs of really dipping here, that would be a catalyst for us to reduce our equity exposure and our risk. But for the time being, positioned for continued success in the global equity markets.
Thanks, Dave. Appreciate that. And I think it speaks to in our returns clearly have spoken to the ability to be flexible, right? To be nimble, be able to move in and out. For the last decade, it's sort of been maybe perhaps a truism that active management has been out of favor. But for the last 18 months, it's definitely, or maybe the last 2 years, definitely back in favor. And we've taken advantage of our ability to be nimble. So
flexibility and agility for sure.
Absolutely. Adam, if we could flip to slide 23. So again, sort of two back-to-back slides here that have a similar theme. Both of them give us insights into how being diversified between growth and value equity strategies can have impacts to returns given where we stand in a particular economic cycle. And as we previously discussed, we have the ability to tilt to growth and or value managers in most of our equity offerings, and our clients obviously benefit from this diversification in the hands of an experienced team, of course. If we switch to slide 24, we highlight some fixed income factors, which honestly don't look especially attractive given the current rate environment and spreads. Rate spreads are the difference in yields between different classes of bonds. For the benefit of our clients. So Dave, can you explain to our clients the negative impacts of a rising rate environment on the bond market, and how should investors view having fixed income in their portfolios as both an important and probably needed diversifier and a hedge against some equity volatility, despite perhaps some muted return expectations from us as their manager?
Matt, thanks. We could spend an entire seminar on the math of fixed income returns, but basically the formula is this. If you've got an interest rate exposure and a duration in your portfolio of 7, and interest rates go up by 1%, you lose 7% minus the return, the coupon on your fixed income securities. And because interest rates are so low here, there is less of a buffering factor when equity markets go down. And so we've taken really 2 approaches to lowering the interest rate risk within balanced funds in particular. One is to have a flexible approach to that interest rate sensitivity in a number of our strategies. And 2, to have a number of diversifiers within the fixed income allocation, such as bank loans, which basically do not have negative exposure when interest rates rise. So that's an important consideration going forward.
Thanks, Dave, for that. Appreciate it. So many clients that have met with Stacy and I in portfolio reviews have heard us talk a lot about the impact of duration. Certainly the impacts of where you stand on the duration curve, and that important diversification within our fixed income fund of having multiple asset classes of bonds, and then 2 really solid core managers between the pension boards team and Nuveen, which was just added about this time last year, really hopefully helps us to navigate what we think is going to be a volatile and potentially challenging fixed income market on a go-forward basis. So Dave, one more question for you, one more slide for us to look at here with our clients. If we could flip to slide 25. We're going to go back a little bit to climate change. It's been a big topic at United Church Funds, really going all the way back to 2013 when we started to create the Beyond Fossil Fuels strategies. We've really been talking about it over the last few handful of months. Brings us to this topic. So clearly, investor sentiment has turned to support corporate engagement initiatives and investment strategies which are geared to change the tide against the destruction of our habitat. United Church Funds and the pension boards, as we heard earlier from Stacy and Matthew, we collaborated to host this climate symposium to educate and engage and move forward with continued vigor in the fight for climate justice. UCF's Beyond Fossil Fuels Fund, Beyond Fossil Fuels Balance Fund have proven competitive performance while divesting from those fossil fuel producers. To put a number to that, both funds have outperformed their Lipper peer group by about 1% per year over the past 5 years. Can you give a brief response to the difference UCF's clients who are invested in the Beyond Fossil Fuels family of funds are making in the fight for climate justice, and maybe talk a little bit about your confidence in those funds' continued ability to generate competitive returns?
Well, thanks, Matt. As Stacy alluded to, we had this terrific climate symposium, and one of the real pivotal strategies that we highlighted was the creation of the Beyond Fossil Fuels Fund, and proud that our investment team here was instrumental in helping form that fund. And the difference really is to assess the risks initially from stranded assets in the ground, and divest from those firms within the portfolio, screen those out, which is really I would call climate impact 1.0. As you've heard Stacy talk about the evolution of the Balance Fund as a corollary here as well, in terms of the potential evolution of the Beyond Fossil Fuels Fund. And I will tell you that the organization is very focused on 2 things. One, carbon emissions and how to potentially evolve those screens. And then secondly, if you are not investing in a sector, what potentially are the additional investments that you can make in terms of companies who are maybe aiding the transition to a low carbon economy. And so I think over the next year, you'll see some announcements on the evolution of the fund. Matt, your last question really was, what confidence do we have in the ability of the Beyond Fossil Fuels Fund to continue to outperform as it has? And that really is the scrutiny of the managers involved. So not only are they applying their trade from an investment financial standpoint, but also utilizing the tools and approaches in climate 2.0 in terms of what's available in the marketplace to help mitigate and help transition to a low carbon economy. So very, very encouraged and gratified, and stay tuned.
Absolutely, Dave. You know, we were, as we turn the halfway point of this year, it's pretty amazing for those of us that were at General Synod back in 2013, you know, some 8 years ago, as we're having the conversations about creating what we know now as the Beyond Fossil Fuels Balance Fund. As you alluded to in the symposium, those conversations weren't always easy necessarily. There was a lot of push and pull about what this should look like. But here we stand 8 years later, and you know, really 7 years under our belts, or a little less, with those funds. The Beyond Fossil Fuels Balance Fund has grown from an idea to almost $150 million in total assets of our portfolio. It speaks to our clients, commitment, if you will, to climate justice, and certainly our organization stands with them as well. So, Dave, I want to thank you and your team for being part of our town hall tonight. I always appreciate that you take the time to be with our clients, to answer questions. Manoti and Lon and you, all three, are here. We greatly appreciate it. As we transition through one more slide and then into the Q&A, I would take this opportunity to invite our clients that are on the call to use either the Q&A or the chat, either one. Right now, if you have a question, throw it in there. We'll try to get to as many of them as we can before our allotted time tonight runs out. This is a final slide. We always throw this, or many times we throw this one into portfolio reviews. And it's just a reminder at the end of this presentation, as we talk about asset allocation strategies, the critical importance it is to stay diversified. That is part of the reason why we are in some reason why we are consolidating our balance funds, so that we can focus on making sure that you have a diversified portfolio that meets your long-term needs, ultimately to fund mission and ministry. So Adam, if you want to switch slides here, we'll go to Q&A. And again, if anyone has any questions, feel free to throw those into the chat or into the Q&A. We had one question earlier on the fixed income duration. Dave used an example of 7, although I believe we're maybe just a little lower than that.
We are, yes.
Yeah. We do have one question out there. It's actually a question about how we withdraw some money from your fund. If you need to withdraw any assets from your accounts, I encourage you to contact our client services team. They can be reached at info at ucfunds.org, and they'll reach out to you with instructions. We'll need to take that opportunity as well to make sure that the authorized officers for your church are updated in our system, so that we can take those instructions and act on them. When we send you money, we will make sure that we have ACH information for your local bank, and we will send that to you electronically once we get all the paperwork together. Yeah, so we're getting a question as it relates to the recording. It will be made available most likely tomorrow. We'll make sure that you get that. Anyone that registered will get the link to the recording. Steve Hotchkiss from Lakewood, Ohio, has a question. What's on the REIT fund? We actually do not have a fund that is real estate focused. We do have the alternatives fund, which includes real estate managers. I believe right now we're using Heitman. Dave, do we use any other real estate focused managers, or is Heitman's pretty much our primary?
Heitman is really the most, and it is a core real estate fund but privately held and not publicly traded, as Matt indicated, in the alternatives fund. Most of you would not be exposed to that fund unless you own the alternatives fund or the alternatives balance fund. Well, seeing no other comments in the chat, I want to thank everyone for allowing us to. Oh, we have one person raise your hand. And another question. You know what? We'll get to these real quick, and then we'll wrap it up with answers to these. A big question: what do you see markets doing over the next 3 years? I think, generally speaking, while we could have some volatility, I think we're optimistic as it relates to the global economy.
And we're optimistic as it relates to our ability, as we mentioned before, to be nimble and hopefully sidestep risk when it happens and able to take advantage of opportunities as they arise. I think there's, and I don't think we're alone in this. And Dave, if you or a member of your team want to chime in, we tend to think that there's some green grass ahead of us, particularly as we move past the pandemic and as we have the opportunity for things like this infrastructure bill and potentially some other legislation that could put folks back to work in good paying jobs across the country, really sort of step into the breach where the federal government has, in the throes of the pandemic. So we'll end on that optimistic note. I certainly appreciate everyone joining us tonight. Thank you to my colleagues for being part of the call. As always, should you have questions about your account, should you have questions about your allocation, we look forward to hearing from you. You can reach out to us directly through our website, directly to our client services team at info@ucfunds.org, or to Stacy and I directly, and we'll be happy to answer any questions you have. Lastly, thank you for the opportunity to be your trusted investment partner. We take it as a serious responsibility to invest the assets of which we are entrusted responsibly and sustainably. And we thank you all very much for the opportunity to do that for your mission, for your church. And we're grateful for your time tonight. Thank you so much.